So the selection of the insurance that you provide on your stock is really determined based on the amount of risk that you really want to take. Now here's something that nobody else is going to tell you. My position when I take these positions, okay, and I actually did take a position in Starbucks. I took a position right around in here. There was like 3 or 4 days where the stock wasn't really going anywhere, and it seemed to hit some sort of bottom here. I looked at this high spike of volume on this day in which Starbucks actually, closed the day before at $17.85, and if you woke up the next day, it's trading at $16. That was a pretty dramatic drop in the stock right there. And people who bought it on that day, the day before, for $17.75, saw it trading the next day at $16. Probably got pretty spooked, especially if they had a fairly large position. Well, I saw that very large volume spike, and generally the large volume spikes like back here and here and here, and then eventually when the stock started railing a little bit and started coming back down, you could see that the volume on the sale side started drying up dramatically. Each day that the stock continued to decline, there was a little bit more volume, but nothing even close to this kind of volume here, or this volume here, or this volume here, in which days and days and days of high selling volume were indicated by these red bars. It seemed to have pretty much dissipated. So a lot of the sellers probably got out at this point, and there weren't too many sellers left. People who were holding either the stock for long term or purchased on this day were eager to hold it and weren't really aggressive sellers at this point. Once that aggressive selling had started to decline, I felt it was a low risk opportunity to start purchasing some shares. Even though volume on the upside did not really materialize, every time the stock declined slightly, especially on these 2 days here, declining volume, these 2 red bars down here, were extremely low. Right in there. These 2 days of very low volume on a day in which the stock declined indicated to me that the selling had pretty much dried up. Now remember, I had been watching this stock for quite some time. In fact, I started watching it back in here, back in July and August of last year. I began to look at the stock when it was really quite volatile here, but there was still a good amount of selling going on. I took a look in particular at this day here. I noticed that the selling was quite large. So what I was looking for is a time in which the stock would come back down to those levels on some selling pressure and price pressure on lower and lower volume. There were some days here in which volume was extremely low. However, there were other days in which there was extremely high volumes of selling. So I decided to wait on the stock. I also didn't see a very good pickup compared to the amount that was being sold on the days in which it was increasing. In fact, during this increase in price here and this decrease here, there was actually selling pressure that was higher than the day before in which there was buying pressure. In fact, as it declined here, the selling continued to increase. You can see that volume increased at a time when the stock was decreasing, and that's generally not a good sign. So I continued to watch the stock. As the stock continued to trade, it traded lower and lower on increasing volume. And that is generally not a good sign. Volume continued to increase as the stock declined. Once again, if I took a good look at, hold on a second. Get back to that. If I took a good look at the trend here it would indicate that in fact selling has increased each time the stock decreased, and that only indicated to me that additional selling pressure would be forthcoming and additional pressure on the downside would be coming. Until it got to the point where here it looked like even though we had one large day here of downward pressure and quite a large spike in volume, during this time there didn't seem to be a lot of pressure on the stock as it declined in price. It wasn't until this capitulation volume right here that occurred, which I always look for. I always look for this capitulation. This is really a climatic selling point in the stock because it's actually larger than any previous of the previous selling days. You can go back all the way to August even of 2006 when we had this large decline in the stock. It was even larger than that. So a lot of the people who were hoping that the stock would advance here, and go back up to the point at which in which they bought the stock, so they could sell it and remain whole. That never happened, and I think people, once they saw the stock drop from this level and gap lower by a couple bucks, they realized that, hey, there's no more hope left for Starbucks, so I'm getting out. So that was the huge amount of volume here that I was looking for. After that happens, then I start to look for a spot in which I could take a position. And I actually purchased the stock right here. And shortly after that, the stock started trading up. Now, did I buy protection? Yes, I did. My point of this analysis is to give you an idea of how to evaluate not only a potential timing point of entering a stock position, but also giving you an idea of how I would have traded this. Generally, what I like to do is let the stock prove itself. In other words, I would have purchased a much better position. If I was to purchase Starbucks now, I would want to purchase the higher insurance policy that limited my downside risk to $430. If the stock proves itself, and it does increase in price, yes, my upside potential is somewhat limited. However, I still make a profit, don't I? My downside risk is, in fact, limited to just $430. And that's an acceptable risk based on an $18,000 stock purchase. What I'm looking for here is for the stock to prove that it will continue to increase in price. If I looked at the chart and I said, okay, well, I think my purchase at this point is probably a good idea because we do have a nice increasing we do have an increase in the price in the shares of the stock from a low of around $15.50 all the way up to $18.50, and since there's a little pullback here, it might be a good opportunity to enter into the stock. If I was thinking that. I'm not thinking that at this point because the volume on the up days is pretty low. I mean, you still have a couple of good up days. You've got higher volume on the up days than you do the selling days, the red bars. So it may be an attractive opportunity. I'm not suggesting that you go out and buy Starbucks stocks. I'm simply giving you an example of what I would be thinking as I analyze the stock and analyze my risk and reward in this position. So what I want to do is I want to be able to purchase 1,000 shares of Starbucks stock, pay the $1,400 in insurance to hold this stock, limiting my downside risk to just $430 until July. Remember, this option, the 10 contracts that we're going to buy as protection for this position, will expire in July. So, what happens at that time? Well, we'll talk about that.